One beautiful thing about understanding market structure and its dynamics is that trading becomes super easy and you can trade profitably, efficiently, and effectively. Welcome back, guys. This is Non Academy. Remember to like, subscribe, and comment if this video has been educational. We'll be discussing one concept of a very profitable trader. It's the pro and counter trends. It's basically discussing how different traders trade in the same market. Okay, so this video is a tip on how to maneuver the markets and take trades effectively. Okay, so let's go down to it. So in today's topic, we're looking at pro and counter trend, and then it's basically discussing two things: the way a pro trader takes his trades and the way a counter trader takes his trades also. So they are both the same concepts, the same markets, yes, but then the two of them are looking at the market in a different view. Okay, so basically now we'll be looking at the pro trader first, then we'll now be looking at the counter trader second, and then we'll get down into the charts showing you the two examples. So this is how a pro trader, when he's in the market, when he's looking at the markets, this is how he perceives it now. So there is our uptrend, impulses and corrections, as we know already. Okay, if you not understood market structure, the impulses and correction you want, you can refer back to our previous videos. It's explained there. Okay, so this is an uptrend, a break here, okay, an impulsive correction, an impulsive move, a break of the previous one, that's a break of structure, and then a retest. So one thing about the pro trader is he doesn't take his trades up until the structure has been formed fully. Alright, doesn't take his trade up until the structure has been formed fully. He already knows for a fact what he's looking at in the market. So now he allows this first move to go, and then the market comes back down into the second point of interest, and then another break. Now at this point, now he has confirmed that this market is working an uptrend. Now he's now satisfied that he can now take his trades. Okay, this one trades conservatively. Yeah, he doesn't waste his moves or something like that, or even look to trade change of characters. A pro trader doesn't trade change of characters. He will rather wait for a confirmation or something like this. Now let's say this is an uptrend now, then there are impulses and correction, and then at this point now there was low that broke the structure. Okay, there was the low that caused the change of character. This low now that caused the change of character. He doesn't take his trade immediately from here. He will rather wait when the market breaks back down, okay, and closes below this point of this area value now, then he can now start taking his trades, knowing fully well that yes, the market has shifted. It's no longer on an uptrend, rather it's now on a downtrend. Okay, so this is basically how a pro trader perceives the market. After this break of structure, let me allow this area of price because we already know what's going to happen there. This is a break of structure right here. Having understood the thought process of a pro trader, we'll now discuss how a counter trader trades. Now, from the concepts of English now, you can understand that counter is going against something. When it's an uptrend now, and then you counter trade against the trend, now you're going against the uptrend, which is trading it in a downtrend format. Let me explain it now. So let's say, for example, now we have an uptrend right here. An uptrend, impulse, correction, impulse, correction, impulse, correction. Now, what a counter trader is looking to trade, although a counter trader also trade this leg, okay, they trade the next impulsive move, but then they look to catch every move that the market makes. Okay, basically now, when the impulsive move has been done, a counter trader looks to sell, okay, selling from that point now where the market has reversed into the area of value below, and then buying also with others. So if you remember correctly now, this is how the market moves. This is the whole structure, but within it now is the substructure. When there is smaller higher lows and higher highs, if you've not understood to this point of substructure, I think there is a previous video on advanced market structure in our playlist, so you can go and view up the video and then understand it very well. So this is what happens now in lower time frame of the substructure of this leg now. So what the counter trader will look to do is wait for the change of character on a lower time frame right here, enter, and then sell into this area of value below. Okay, area of value of a higher time frame point of interest, selling into here and then buying also with others while the market is going up. Okay, so that's basically what a counter trader does. He looks to buy. Scalp traders also do this. He looks to buy at this point, and then while the market is also moving up, he trades with them. Okay, so I think at this point now we've explained textbook diagram of how pro traders and counter traders perceive the same market. Okay, so this is the same market now. Let's get out to the chart. So I'll show you something, a few things, and then we'll go. So on AUD card, 4-hour time frame, and this is an uptrend. What a pro trader will do is, the trend started forming here because if you look, this is our previous low. I created the breakout structure and then the market violated it. Okay, and then now came back down into an area value right here, and then started going. So a pro trader now will not take his entry on this first leg. He's not sure if the market is already on an uptrend. He'll rather wait for the next leg to form, and then he will now take his trade on the next. You get, so taking his trade from here up, and then another one up, like that, and then you can see that he always takes only the impulsive move, and then he waits for the confirmations to be there. Okay, he is a conservative trader. But then a counter trader doesn't really care about if the market is changing or not. He's a risk taker. He just looks for entries in between lower time frames, and then he buys with them or he sells with them. Okay, so how do we now identify these counter trends? If you want to trade a counter trend, how do you now do it? This chart doesn't show much of an example. So basically, if you want to understand counter trading, you do it from a higher time frame level that you've already known that this is an uptrend, and then at a certain point now it rebounds on an area of value on the uptrend, and then it's selling. Okay, it's selling to buy. All right, it's selling into an area of value below to buy. So let's go down to euro GBP. I think he has a better explanation. Yeah, this is it. Let me now explain this now. So we are an uptrend euro GBP 4-hour time frame right here, but then along this point now there is an area of value. This is a buy rejection candle, left long. That's why I picked it as my area of interest, leaving also a fair value gap right next to it, so it's an A+ setup for me. Okay, so this is my area of value now. Then what did the market do? The market came back into it, mitigated it. Now this is what the pro trader will do after getting and understanding that this is an area of value on the 4-hour time frame. It will now scale below to lower time frame. Let's say I'll use 45 minutes if it's ready to me. He will now scale to lower time frames to find his entries now in order to sell this trade to the area of value down. Okay, so basically now from this initial price, this was the low right here. This was the low that formed the last break of structure here and here. This low formed the last, and then the market came and violated it impulsively. Okay, after the violation now it left a fair value gap above. If you remember the video on hierarchy of entry models, you remember that fair value gaps has a high probability of being mitigated than other blocks. So it's on the third, and another block is on the fourth. So the market came into this fair value gap and mitigated our fair value gap right here. The 50% consequent encroachment. You can go to previous years still, there is the fair value gap. So it mitigated this 50%, this consequent encroachment of this fair value gap, and then it sold. So a lower time frame trader now will take this entry, that is like a counter trader. You will take this entry now, riding this move from that 50% down into the external liquidity, maybe stop loss slightly above, and then down into this external liquidity right here. So let's say you leverage this trade on $100 account or with $100, let's say, you'll be going home with $1,000 because look at the risk to reward. It's 10-hour risk to reward. So this is basically what a counter trader will do. Aside this now, this is another area that the market broke, creating a break of structure now. So for a pro trader now, this can actually be a confirmatory entry. Okay, so he will now look at taking his entry from this move right here down. Okay, so at this point now, let me remove this so I'll see the next thing I'm doing. All right, so at this point now, this whole candle is long, and as somebody who would want to refine his entry, I'll go down to lower time frame, let's say 15 minutes now, in order to get a more concise entry so as to take the next entry that is still on the same cell. Okay, so this is it, and if you look well, there is a slight fair value gap there before our order block above. So I would want to pick the fair value gap right there and then mark out my order block for stop loss purposes, so that I'll place my stop loss right above it. So that's basically it now. Now a counter trader will also take this setup now. Still buy. Remember, this is a buying position. We're on a buy, but the counter trader, he wants to catch both the buys and the sells. Okay, so that's catching these reversals, these small moves that is selling into the area value down and then another buy. Okay, so basically now, getting back to my 45 minutes time frame and then targeting the external range liquidity right here. This is where our target. Okay, this is where our target, because look at the week left, long week. Then setting my stop loss slightly above. So if you look clearly now, this is a very good setup. A 10-hour trade also, a very proper setup. Okay, so with a $100 account still, you're making massive amounts of money. And then remember, we're only trading the substructure now. We're not even looking at the overall structure that is on a buy. You get, we're not even looking at the overall structure. We're just trading this inner one, so that when the market sells, it sells into an area value, and then we can now buy with the orders. Okay, so I think at this juncture we've come to the end of this session. All right, so having been here from the beginning till now, you'll testify that the video has been very helpful. So do also leave a like, subscribe, comment, and above all, share the video. Okay, reach out to many other people. Okay, so we would like to see you in the next video. In the next video, I think we'll be discussing engineered liquidity, because that is a very huge topic that many people find it very what do they call it now, very difficult. So we'll be detailing it in the next video so that you can understand it. If you look clearly here, you can actually see that the same thing happened. It's an engineered liquidity here. I wouldn't go into detail with it, but this is our entry, and then this is the buy, and then the liquidity sweep up here. So this is also an engineered liquidity, but we'll look into it in the next video. So stay tuned, and we will see you in the next